guys, this is Mommy Beluga Investing.
Hi, welcome again to my channel, Mommy Beluga Investing, a YouTube channel from a mother learning to invest for family future. After a few months break in 2023, I'll start our 2023 videos through looking back at our family's 2022 investment. This year we are probably releasing less video, but hopefully it will allow us to give more time to add more in-depth content into our videos. Disclaimer, this is an amateur video. My main intention is to record my journey learning, investing, and managing my family finance. This video shouldn't replace any financial advice. Every family is different. What I share here may fit to my family, but may not fit to yours. Please conduct your own research before making any financial decision. Now let's start with our cash flow at a glance. We haven't changed our strategy for about 3 years from now. At first, we target to have 12 months of emergency fund. Now the amount is around 5.5 years worth of expense, which has exceeded our target, but we're still setting aside around 20% of our salary when we receive them. Then, if we don't have any big expense in the month, we can usually set aside around 10 to 20% at the end of the month. So in total, we could save around 30 to 40% of our salary every month. Mind you, this is only our salary. The income from investing is reinvested into other investment products, but it's outside of this calculation. So now let's look at my family finance at a glance. My family divide our finance, at least for now, into 5 components. The first one is our property. The second one is our cash. The third one is our investment. And then the fourth one is our CPF, while the last one is our debt. Okay, each of the components are presented with regards to the other items in the list. So we have a sort of like comparison between the numbers for the amount for each of the components. As we can see on the graph here, our property value makes up almost a quarter of our total net worth. Though SG property value is in the hike recently, for our own record, for my family record, we didn't take that into consideration yet. So we maintain the same property value from June up to December. Exactly the same one. Why? Because we don't really have any plan on liquidating or selling our property in the near future. So there's no use of us to, take our property into consideration, at least for now. And I'm quite happy to see that our debt is lower than our cash position. So by right, we have enough cash if we want to pay our debt. As for investment, at the moment, I do not have any way to gauge whether this is a good number. 18% is a good number for now. Okay, perhaps, yeah, it would be better if our investment can be as high as our CPF or even higher. As a note, we continuously perform voluntary top-up for the past few years to our both CPF. Our cash and investment would have been higher if we didn't top up our CPF. As for the reason why we top up our CPF regularly is to secure our investment through the safest means that's currently available. I think for now I can be happy by seeing that the combined amount of investment and cash, is higher than our CPF, though not that much. We also did a bit of a calculation comparing the amount of each of our asset class compared to the June 2022 number. June compared to December 2022 number. So here's the chart on our screen is a difference of the value for the all 5 asset class. Compared to June 2022, our property remained the same, yes, because we didn't re-evaluate our property since, as mentioned earlier. The next one is it will be uh, our cash. Yeah, I'm quite happy to see that our cash investment and also CPF increase, though not that much, but it's only 6 months. But yeah, I'm quite happy with the number. Additionally, in 6 month period, okay, this is the highlight here. I can see around 1.6% decrease in our debt. Okay, I'm not that happy actually, because our debt is only our mortgage, because we regularly pay our credit card bill in full every month. Since this is our mortgage, yeah, the percentage of decrease opened my eyes, because first of all, mortgage is one of the highest expense in my family compared to food, communication, transport, entertainment, etc. So it's the highest expense. And after paying that much for 6 months, the number only decreased less than 2% by only 1.6.8%, which I think is very small. And now let's continue with seeing our investment. This is the breakdown of our investment. We have bank deposit, money market fund, and government bond. In this case, our government bond is actually mostly SSB, Singapore Saving Bond. After those three categories, yeah, on the less risk investment, we also put our investment in stock, yeah, which consists of individual company, ETF, and also rate. Previously, we also put some of the yield from the less risky investment to peer-to-peer lending and also cryptocurrency. But by December 2022, the numbers from those two categories, yeah, peer-to-peer lending and cryptocurrency, have been almost negligible, very small. With the raise of interest rate in the less risky area, for us, like both of us, we feel that we cannot justify putting our money into those more risky investments. We also try as much as possible not investment. So yeah, that's why we try to move our money back to the more to the less risky investment with more yield actually compared to the previous year. Okay, the next one is that we also keep it in our mind that we also try as much as possible not to use any of the income from our investment for our consumption or living expenses for now. That's probably, we're probably going to start doing it for our retirement later. Okay, now let's see what's the proportion of each of the investment or the asset class. As of December 2022, here we categorize our investment into stock ETF, money market fund, and then government bond, bank deposit, rate or real estate investment trust, bond ETF, and peer-to-peer lending. And here is the percentage with regards to one another. Yeah, put it in the pie chart so I can have a quick view at a glance, like how much of each of our investment with regards to the other. Our stock is actually slightly less, yeah, than half of our total investment. Yeah, so far. As before, I'm still under the impression that our family has a low risk appetite, but this graph proven that my impression is probably not that correct, but we try as much as possible to maintain investment in the less risky area. Okay, our stock ETF turned out to be pretty small compared to our total investment, and seeing this number, it's still pretty similar to our June 2022 number. So I'm planning to keep DCA at dollar cost averaging to add my position in index ETF. So far, ES3 index ETF, yeah, that tracks Straits Times Index historical dividend yield, is the one that I'm keep DCAing, dollar cost averaging, so buying it every month. The dividend yield is around 2 to 3%, so I think it can be achieved in low risk investment that I should add more into our portfolio. Then our second biggest investment is actually the government bond, Singapore saving bond to be specific, with 2 to 3% average return in 10 years. I think it's a good way to anchor our investment. So we are still thinking to keep a dollar cost averaging for SSB as well. All right, this time I'm thinking of tracking the yield of each of our investment or asset class. Roughly, this is the number here. The number is mapped to our acquisition cost. The yield for 2022 mapped to its acquisition cost. Our full year 2022 yield for all investment is 3.24%. Yeah, and seeing this chart, we realize that the highest yield is actually coming from our stock. Yeah, while the lowest yield is coming from our government bond, which is our SSB. I think this should be about right because SSB is our safest investment. So it's okay, or it's about right to give us the lowest yield and vice versa. I'm quite happy seeing our numbers, and through reviewing the numbers, we kind of like roughly know what will be our next strategy. At least for now, after seeing the numbers there, we have several plans in our mind or lesson learned. Yeah, the first one is that we are going to continue setting aside our salary for our cash stash and investment. So we have cash stash that can be deployed during bad market, and just to provide us cushion for anything that can happen to our family. The second one is buy more individual stock and ETF using our cash and investment yield. The next one is invest in government bond as long as the yield is higher than 2.65%. Otherwise, it will only drag our yield down. However, since government bond is, if we are talking about SSB, is quite safe and easy to redeem, we probably can just put, every month in SSB, but then redeem whenever redeem and put in the new SSB that give us higher yield. Yeah, that's another plan. And then note to self. Yeah, the data speak for itself for long term in stock. So far, by holding long term or DCA and avoid both panic buying and panic selling, we have got 8% yield from the so-called current bad market. And not to mention, we also have more than 50% capital gain so far. By setting our salary aside every month, we also have cash stash that also help us not to do panic selling, because we don't really have so far, at least we don't really have any needs for us to liquidate the money that we already put in our stock. Alright, so that was my family asset allocation and yield review for December 2022. Follow my channel for individual stock analysis and occasional update on our finance and investing journey. Please subscribe. It means a lot for a beginning YouTuber like me. That's all for today. See you again in my next video. Bye.